All right, hi everyone. Welcome to Making Multifamily Money. So today I actually don't have a topic to discuss about, but we had a lot of new faces here, so I would love to kind of go around and kind of introduce ourselves and kind of what our interest is in terms of real estate, like how much real estate you currently own and what you're trying to look to do. So maybe let's just start with Rudy, since he showed up first.
Thanks. Yeah, so I'm a beginner at this. I have another mentoring program that I'm in, so I have all the knowledge. It's just applying it now. So I've been just saving up money since then, and I've been focusing, unfortunately, on a very expensive market of South Florida, which I've learned very quickly that it's not a very good place to look. I've just been hanging out with brokers, just showing me overpriced properties, which has been fun. Not really, but it's just good to see how they work and how they talk. If there's any real estate agents here, I'm sorry to offend you, but yeah, Steven's right when he says they are overpriced. I know they're trying to make a commission because that's how they make their living. But once you figure out what the numbers are and what the criteria is, you quickly understand what a property is going to be as far as cash flowing, or if you're going to lose your butt. So it's that's where I'm at right now. So I'm pretty much a beginner, and that's where I'm at right now. So I'm looking to probably look out of state, or north, maybe in state, since I am in a landlord friendly area. But with insurances and taxes are high, it's still a challenge. So I might focus somewhere else, and that's my next step.
Okay, great, Rudy. Kind of two things I want to touch on that you mentioned. So first of all, you're a pharmacy technician, right?
Yeah,
That's your day job. So I would say I would give you kudos because honestly, I'm a pharmacy director. I oversee pharmacists and technicians, and pharmacists don't even focus on investing in real estate. Like it's
yeah,
mostly like, to be honest, I never seen a technician invest in real estate until I met you, to be honest. And I've been in the
really.
profession for 10 years. So definitely kudos to you for that. Because like you said,
Thank you.
you don't need to make a lot of money to start investing in real estate, right? It just really takes the right mindset. And you're part of the mentorship. I'm sure you're part of the same mentorship that I was part of. Yeah. So in that program, I mean, to be honest, any mentorship program, the education, it's there. I give a lot of it for free, on my channel. These sessions that I do, I give quite a lot as well. But the key is just implementing it and following it. And that's where most people fail in mentorships is like, so I came from Peter Harris's mentorship, and basically his big thing was direct mail, which is how I learned how to do direct mail. And the problem is people like don't consistently send out letters. Like when they literally say send 300 letters a month, it sounds easy, but no one does it. Right. And I was one of the few who actually did it. And that's how I was able to buy 2 apartment complexes. Right. So, um, information for the most part, it's pretty similar, to be honest. It's just a matter of, fortunately, when people kind of put money online, you're more motivated to want to like take action versus like if you get stuff for free, unfortunately people don't take action. That's why, listen, like Bigger Pockets, whatever, people are stuck on the sidelines, paralysis analysis, right? So for me, when I put money where my mouth was, invest in education, I just said I have to get an apartment complex or else this money would be a waste. And it was expensive. It was like $15,000 to join. And that
Mhm.
was the cheapest one. It went like 15, 30, I think 45K. That was back when I did it. So, it's great. I learned a lot from it. It got me, I think the number one thing it did for me was it just shattered my belief that I could own an apartment complex. Cause I'll be honest, I didn't think I would own one. But once you're just around people who are like buying apartment complexes left and right, it kind of starts to feel normal to own an apartment complex. So, once I kind of had that mindset, like, hey, I'm meeting people just like me, average, W-2 worker, just like me, and they're buying apartment complexes. So it just kind of gave me the belief that I could do it. And that's how I got mines quickly. And I got my second, third shortly after that. Right. So it was just kind of like a mindset shift for me. And that's how I scaled rapidly. And then the second point that you talked about is talking to brokers. Right? So I'm really hard on brokers too. You can check my YouTube channel, right? I've said it multiple times, brokers make you broke, make you more broke. And the reason is like brokers are too transactional. They don't think like an investor. That's the problem, right? So like I will literally underwrite a deal for broker side by side and just say, hey, like you want this purchase price of let's just say $2 million. And I've underwritten multiple deals on my YouTube channel. You can check it out. Sent to me off market from a broker. You know, I know the deals are bad, but I just underwrite it for fun, for practice, right?
Same.
You want to look at a deal and like in Oklahoma City, in my market where I invest in, I can look at a deal in like 2 minutes. I'll know if it's a good deal. That's how comfortable I got. And I did that because I practice, right? I underwrote bad deals. So I know what a bad deal looks like. So if it doesn't look like that, it's going to be a good deal. But brokers, number one, so the value of the apartment is based on the net operating income divided by the market cap rate, right? So NOI is income minus expense. It's basic math, right? Cap rate, it's market specific. So I invest in Oklahoma. It's an 8 cap market. So whatever your NOI is, you divide by 8%, right? So, you know, to inflate the value, it's just math. What brokers do is they'll inflate the income and give you a pro forma income. They'll lower the expense. And what does that do? That inflates your NOI. So it justifies a higher purchase price. But if you've owned real estate, like as long as I haven't owned it long, but once you start to own some real estate, like I know in Oklahoma City, my expense is 50 to 55% of my gross income. And I know that based on experience. And these brokers are giving me expense ratios of 40%, 35%. So automatically I know that they're inflating it to get you to justify a higher purchase price.
Right.
So to me, like I always say, like I've never had a broker bring me a good deal. I've never had a wholesaler bring me a good deal. So instead of complaining about it, I started a direct mail campaign. And I go direct to the seller, bypass brokers. And honestly, it's a lot smoother, a lot more transparent, right? Like,
yeah.
My first deal, I got it for $500,000, 26 unit. It appraised at 750K day one. So I made 250 equity day one, just because I sent a letter out, right? So I spent $3,000 on letters, and I got 250K equity day one. To this day, fast forward 2 years later, it's probably worth close to 1.5 million, and I put in about $200,000 worth of renovation. So I'm all in for 700,000. It's worth 1.5. I was getting offers on my 26 unit like a year ago for like 1.3 without doing a single renovation. So, to me, like a broker would never give you that type of deal. And, a lot of people, they don't like want to work with a broker because it just feels so transactional. Like I always joked, if you listen to my other episodes, like I'm probably gonna become a broker one day. I could probably be the best one because like they're all terrible and they don't know how to view the deal. But I might be a bad broker because I might take the deal for myself, right? I don't want to sell it. I want to keep it, right? So I basically echo your sentiment, and I apologize in advance too. Like I've never had a broker send me a good deal. They're too transactional, and at the end of the day, they're just worried about the commission check, right? Like, I'm trying to sell, my mobile home park right now in that process and working with brokers. And like, honestly, it's harder with brokers involved because like, it's like playing telephone, right? I tell my broker something who tells their broker something who tells the end buyer something. And the message gets so misconstrued and it lacks personal touch that it's hard to like negotiate or like build rapport. Versus with the owners, I literally can talk to them. They see me, I see them. And we start to build trust, and that's how you negotiate better terms, right? Like my 26 unit, I negotiated 70K in seller repair credit, which cut my down payment in half.
That's awesome.
I have a video coming out, I think either tomorrow or this week, about how I bought my 26 unit with 60K down. I put 60K down and I bought this 26 unit apartment complex that appraised at 750K day one, right? Like 60K is not, it's a lot of money, but I'm coming from California where average single family home is $1.5 million. Right? I bought all single family homes in California with at least 150K down, 10% down. So to me, it was just a huge, mind shift for me to go off market. And then also, to be honest, when you're starting off, brokers don't take you seriously either. So most 9 out of 10 brokers are terrible. That 1 out of 10 broker that's good, they're not going to bring us the deals. We're new.
They're not.
They're going to bring the deals to the people that they've worked with before, right? So
Yeah.
you're kind of stuck in this catch-22. And same with lenders. Like lenders, they're not going to trust you if you have no track record. But it comes to the adage of, well, how can I build a track record if I don't get my first deal? Just like, how can I get experience if you don't give me the job?
Right.
So it's just kind of like, for me, I just said, okay, I'm gonna find a deal so great that the lenders will overlook the fact that I have no experience. So if you bring a deal that appraised 250K over what I bought it for, I think they will overlook the fact that I don't have experience. Right.
There
So
you go.
that's basically what I did. So, huge proponent for going off market. Even if I start looking again on deals, I probably would go off market again. Like, I don't think I would honestly use any broker. I just would, use connections that I have, whether it's property managers, they have a lot of good off market deals as well, and direct mail moving forward. Unless a broker proves me wrong, I'm hoping so. But never had a great deal sent to me from a broker. So
I have a question, Stephen, real quick. I haven't seen all of your videos, but do you have one on just negotiation? Because I other than building rapport, once you get past that stage, negotiation, I think, is like the next, at least in my mind, I don't know if it's true or not, negotiation is the next step as far as closing the deal and making it a win-win situation somehow for both of you without making it sound like someone is losing, right? I mean, you're asking for a lower price, and that makes it sound like the seller is losing money and making you look good, and maybe it feels like to them that you're stealing their property. So there's obviously a balance you have to reach when you're negotiating. I know you have to read it per deal, per person. I just want to know how you approach each situation, because that seems to be a very difficult subject to teach, because in our mentorship that hasn't been touched up much. I mean, it's more relationship based, which is fine, but once you hit that point, sometimes the negotiations go stale because you don't know how to negotiate. So I was just wondering if you have any insight on that.
yeah, so it's all soft skills. And fortunately for me, I've been a pharmacist for 10 years now and a pharmacy director for the past 6 years. So what really translates well is negotiations, right? Like, I work in a hospital, I'm negotiating between pharmacy, nursing, pharmacy, physicians, right? So I'm kind of like the mediator. So fortunately for me, I had a skill that translates very well into real estate, right? Or just business in general. So for me, so my first guy, he was literally a lawyer, and he only wanted communication via email. So I had two things working against me, right? Number one, he's a lawyer. Those are hard people to negotiate with, right? They're very write it, everything written, right? And number two is it's hard to build trust if I can't talk to you on the phone or see you, right? Like, I'm in California, I'm buying deals in Oklahoma, which is like far away, right? Tack on top of that, I'm some random Asian guy, right? and in some states you buy on, Asian's not as common. So, it's just to be honest, to be transparent, that's a hurdle, right? That you're gonna have to overcome. And for me, it was just like, for me, I'm always a pretty fast communicator, as you can kind of tell, and I'm very open, very transparent. Like, I'm in the process of selling like my mobile park, and it made me realize how action oriented I was. Like, literally, if you like, I always say, hey, so usually if I talk to the, let's say I send a letter out, they'll reach out to me, we'll schedule, I call them. Usually, I just talk, and, there's a bunch of questions I'll ask, right? Like, oh, hey, tell me about or how long have you owned the property? It's usually a kind of quick first question that you start with, and you want to get them talking. And at that point, you're going to get a lot of information from the seller, right? And from there, you just kind of want the basics, right? Like, how many 2 bedrooms, how long have you owned it? If you owned it for 20 years, what does that tell you? The loan's probably paid off. You can get seller financing, right? That's pretty basic. And I have videos I have like 250 videos on my channel, so I'll probably touch this somewhere. And then the next one is, once you kind of get that conversation rolling, how I usually kind of end it is like, okay, like, why are you looking to sell? Like, I'm trying to understand what their motivation is, right? Like, are you looking to retire? Are you in pain? Are you a tired landlord? Is it distressed? Is there like, I call it the 4Ds. Is it death, divorce, disagreement, or disability? Did one of those 4 things happen? And that's why you're more motivated to sell. So once I kind of understand their motivations, their pain points, I can craft an offer that makes sense to them. Right. So it has to be like very personalized. Like, so for me, like I'm very quick at making an offer. Like I'll tell them, I just say, hey, my lender needs a T12, which is a profit and loss statement, and a recent rent roll. Right. That's pretty basic stuff. And then from there, I would literally ask for that and say, hey, the moment I have that, I want to run it through my lender, and then I'm going to write you an offer or LOI. That's the initial offer, right? It's non-binding. So once I submit that offer, I'm always prepared to, they might say no, or they might object, right? In that guy's case, he actually accepted my first offer. So I was lucky. So what I kind of teach is there's a 3 offer method. Number 1 is net operating income divided by market cap rate. That's math, right? Number 2 is price per unit for that market. So Oklahoma City is 50K per unit. So you do the math, 50K per unit, 26 units. That's offer price stabilized. Number 3 is a tax assessed price, right? So that's 3 offers. And what you do is once you have all 3 numbers, you take the lowest of the 3. And all the time, it's always gonna be the tax assessed price, which is public information. Yeah. You can Google it. Like I literally Googled Oklahoma City County Tax Assessor's Office, punch in the address, and I saw the address and said, hey, it's worth $500,000. And guess what my offer was? $500,000. And I was prepared for him to say, oh, that's so low. What are you doing? I just said, oh, well, this is, the tax assessed price. Like, that's why I made the offer. I just didn't pull it out of my hat, right? Like there's a reason for that. But I kind of know what my max price is, right? And how to calculate your max price is it's basic math again. Debt service coverage ratio has to be around 1.25, right? So once you have your NOI on a monthly basis has to be 25% higher than the monthly debt service. So your monthly mortgage payment, right? So if, let's say your monthly mortgage payment is $1,000 a month, then your NOI has to be 25% higher than that. So that's how I do it, right? And honestly, I do the math with the owners as well. Like I'm that transparent. I'll tell them like, hey, when the bank underwrites the deal, this is how they're underwriting the deal. I'll show them the numbers based on the P&L that they gave me. So literally, kind of my superpower, I would say, is I'm just very good at educating people about my thought process and being very transparent about the thought process. So, and that shows, right? So they know that like, I'm not trying to cheat them or anybody.
Right.
I'm literally running the numbers with you and teaching you how the lender underwrites the deal. So that I know how to make an offer. I will literally, I tell them up front, like, this is how I can make an offer. Otherwise, if you do not want that, I cannot do bank financing, and you're gonna have to give me creative financing on this deal. So if it's paid off, seller carry first, they become the bank. If there's still a loan, you take over that loan subject too. Those are your 2 options, right? So that's how I kind of do it. So to kind of summarize it, for me, it's very educational and it's very transparent. And I basically do what I say. And honestly, like if you do that, you're better than 99% of all sellers. And that's why I figured, at first I wondered, like, how did I close on so many off-market deals? I thought, for me, that's all I knew, right? But once I'm trying to sell my park and I've seen the other end, I'm like, gee, these people are terrible. Like, they're so bad at communication. They take forever to respond, and they don't do what they say. So I get why brokers get jaded, because you're working with so many shitty, buyers who don't do what they say, versus me, I just do what I say. And literally that just makes me better than like 99% of all buyers. Right. So like, I scaled rapidly to 90 units and, I kind of burnt myself out. You can check a couple of videos of me talking about that. But like, because I know when I'm ready to find a deal, I can find a deal. I'm not even worried at this point. Like if I'm ready to buy, I can probably get another apartment complex within like 3 to 6 months off market. Like if I put my effort towards it. So
Mhm.
it's kind of ironic. Once you know you can get the deal, like you're not as motivated, right? It's just kind of, it's just kind of like, if you know you can like buy your dream car, you have the money in the bank, it's not as exciting versus like when you had no money to buy it, right?
Right.
So yeah, that's kind of been my mindset. Honestly, it's been a soft skill that I developed, but what I've been kind of doing is, for those that I'm helping, they would talk to the owners, and sometimes if I'm available, then obviously I try to be listening on the calls too, or like I
Oh,
would
wow.
debrief. Yeah, I would debrief with them, so to say, hey, like this is what we could have done better, right? So like in the hospital, it's very common, like if there's a bad situation that we went through, at the end we'll stop and we'll debrief and say, hey, this is what we could have done better next time.
Mhm.
So yeah, it's the same concept, applied to real estate. So I'm just pretty systems oriented, and love to teach and love to learn, and I love to be involved as well, just because it gives me an opportunity to learn as well, and to kind of hone my craft. So it just takes volume there. So yeah, hopefully that answers the question. It just takes
Yeah.
practice. Yes, for lack of a better word, it takes repetition and volume.
Okay.
You know, I, I
Practice.
sent out I sent out at least 2,000 letters and probably talked to like close to 100 people. So and on my day job, I talk to people on a daily basis who don't know what the heck they're doing, and I'm educating them on a daily basis. So 40 hours a week of educating people. Um, plus doing these sessions, right? It's just more education for me. So hopefully that answers your question.
Yes, it did.
Yeah, it's a pretty big crowd here. Anyone else? I guess that's not Sandy. Sandy Zhang. You want to
Hey, how's
introduce
it going,
yourself?
guys? Can you guys hear me?
Yep.
Okay, nice to meet you guys. uh, Thanks for putting this together, Stephen. My name's Sandy, pharmacist as well, and I work in informatics. I do real estate on the side, helping manage my own properties along with some family assets. Currently under contract on a 10-unit apartment building in Austin, and wanted to hop on this and ask you some questions, Stephen. Can I throw them over to you?
Yeah. Fire away, man.
Okay, so this is my first commercial mortgage loan, and the options of the loan types are fairly different. You get 1-year bridge loans. I've been thrown a 10-year bridge loan and 30 years, which is pretty standard. When you did your first one, which one did you go with and why?
Yeah, so my first one was my 26 unit. I used Bank of the West for that deal. They got purchased out by Bank of Montreal, so they're under a transition right now. But at the time, I was quoted 4% interest. This is 2 years ago, right? So this is when it was real nice. I just did a refinance. I was at 7.5%, just for some context, right? 2 years later, same bank. So I got 4% interest. It was fixed for 10 years, and it's amortized over 30 years. And it was 25% down, right? So for me, what I kind of recommend people that I work with is you want it fixed for at least 7 to 10 years, about 5, 7, or 10 years, depending on your situation. So for me, because I knew 4% was so low, I wanted 10 years fixed, right? And it's actually paying dividends right now, because right now interest rates are double what I locked 2 years ago. And I don't know when interest rates will lower. My guess is, I think I made a post somewhere that I think, geez, what was it? 2021 was the equivalent of 2006. 2022 is equivalent to 2007, which is when it was uncertain. 2023, I think, is equivalent to 2008, which is when it's crashing, right? 2024, next year, is going to be like 2009. And then 2025 is like 2010. And that's 2010 is when the bull market started, right? So for me, I'm banking on the fact that in 2025, when I'm ready to buy, it'll be like a 2010 market again. But anyways, I kind of digressed there. For me, when you look at 5, 7, or 10-year fixed, the key thing is look at the prepayment penalty. So usually they'll say something like 5, 4, 3, 2, 1. What does that mean? 5 means 5% of the loan amount is your prepayment penalty. So if your loan's $100,000 and you cash out refinance a loan within 1 year, you're going to pay a $5,000 fee, right? In year 2, it's 4%. It's going to be 4,000. Year 3, it's 3%, 3,000, so on, right? So you want to find balance of wanting long-term, but not having a huge prepayment penalty, depending on your exit strategy, right? So for me, my exit strategy is always cash out refinance. I hope that's what I say right now, right? So for me, if I'm doing value added real estate, I know it's going to take me 2 to 3 years to renovate all the units, which usually entails kicking out most of the tenants, renovating it slowly, and bringing a new tenant base to raise the rents, right? That's what you're doing. So, you know, and from my experience, is about spot on. I've been doing this, my 26 unit for 2 years now, and I think finally I have my last 2 units I need to finish renovating, and then I'm done, right? But I still got like 5 units I need to rent out, which, you know, for context, 5 units times 700 is 3,500 more a month in cash flow. So that's where it starts to become very positive. So for me, since I know I'm doing cash out refinance, I did a 10-year term because it was 3-2-1 for the rest of the 10-year term. So I knew that it's gonna take me at least 2 to 3 years to stabilize it. Then when I do a refinance, it's gonna be 1%, which isn't bad, right? But given the current interest rates, I'm probably not gonna do a cash out refinance until interest rates are honestly around 5, right? Like, to me, it's not worth it. I'd rather just sit on the cash flow, sit on this golden goose that I created, and, you know, kind of reap the rewards of my real estate. You know, so that's why I kind of went that with that financing. And I am personally guaranteeing it. It's a recourse loan. So if I file bankruptcy, they can come after me personally on that asset. So, but if you do that, you usually get a lower interest rate. You know, they did look at my debt to income ratio. So that's how you get better terms, right? So that's the option I chose for, honestly, my 26 unit and the cash out refinance I did for my 20 unit. Same lender. For my 20 unit cash out refinance, which I just finished, it took me 90 days to do a cash out refinance for an asset I owned. Just keep that in mind. It took me 90 days to do a cash out refinance for something I owned already. That's how hard it was. I literally bought my mobile home park, 2 apartment complex, 45 days close.
So what part of the, sorry to interrupt, what part of the process took the longest? Why did it take so long?
Well, what happened, because there's so much uncertainty with interest rates in the market right now, lenders are scrutinizing way more than they were before. My appraisal was way less than I expected. My cap rate expanded significantly. I thought I was going to be at 8.5 cap. It was a 10 cap. So if your cap rate expands, what does that mean? It lowers your value, even if you have the same net operating income, right? So appraisers are pessimistic about the real estate market. The lenders, they looked at my past 3 years of tax returns. I've never had them look at the past 3 years. And then when you buy apartments, the whole selling point of apartments is they look at the asset, not the operator, not the owner, me, right? They want to see the income of the property, but they're looking at my income. And keep in mind, I make a good W-2 salary, right, as a pharmacy director. But they're just looking, they're scrutinizing everything. Like, why is your W-2 income trending down the past 3 years? And I have to explain that, you know, number one, I got laid off during COVID. And number two is I relocated to a market that pays less. So I just felt like every step of the way, it was just like question after question, hurdle after hurdle, and it was just delay after delay, right? So it just took way long. And, you know, I had a hard money loan on that 20 unit that I bought it with, 9% interest only, hard money loan. Ironically, like some interest rates I was being quoted was higher than my hard money loan that I got a year ago. So it was just like crazy. Like, so, you know, I had a 12-month term on that hard money loan, but luckily, because I had a good relationship with the hard money lender, they kind of gave me an extension for free. Usually they charge you like, you know, 2%, plus they raise your interest rate to like 11 to 12%. But because I just was explaining my situation and giving them updates along the way, you know, they're willing to work with me. And even they're just like, wow, it took 90 days to do a cash out refinance. I just said, geez, man, like that was the hardest loan I ever done. And it should have been the easiest loan, right? Like cash out refinance is the easiest loan to do. And it took 90 days. So I definitely know what pain you're going to go through. But, you know, expect to need extensions. I'll be honest. if you're buying in this market and it's not a DSCR loan, if you do a DSCR loan, your interest rate's probably going to be like 11% plus, but they won't look at tax returns. They won't scrutinize as much. They just care about the DSCR. But you have to pay a higher interest rate for that, right? If you want like a lower or better interest rates, like what I was getting around the 7.5, honestly, they're gonna have to scrutinize your tax returns, everything, your track record. They want to see your debt to income ratio, your credit score, everything. Everything is gonna be, they're gonna flip every stone about you.
Okay, and I don't mind that. I thought these loans in the commercial side were almost always DSCR once you go past like 5 units or more. I guess you're saying that's not the case. There's a lot of options out there in which you can do personal guarantee.
Yeah. So when people do like the Fannie Mae, Freddie Mac loans, the government-backed ones, those are the ones that are non-recourse. So basically, if you walk away from that non-recourse loan, they can't come after you personally. So like if you guys heard in the news, that San Francisco, those 2 large hotels in downtown San Francisco, the operators walked away from it because they had non-recourse loan, right? So basically what they did was they raised the value over the past 10 years, did multiple cash out refinances, pulled all their money out. So they have $0 in the deal. And when the hotel business did bad, they walked away and the lenders can't come after them personally. So that's the beauty about getting non-recourse debt, right? Like you can get it. I know lenders that do non-recourse debt, but it's a higher interest rate, right? So it's a trade-off. And, for me, I just want a lower interest rate right now. But honestly, when I'm more stabilized and, I'm more cash flowing, I'm probably going to pivot towards non-recourse debt because I don't want that personal liability on me down the road, right? So you have to really assess, because for me, I have the mindset I'm going to cash out refinance probably every 3 to 5 years, at least while I'm scaling. I might hit a point where I don't want to scale anymore. Then I might just sit on my loan, right? And maybe pay it off. So you have to constantly reevaluate what your end goal is. And then that can help you pivot your strategy, but you also want flexibility because what you want today might change in 5 years, right? Like that's probably going to happen to me as well in 5 years. So did I answer your question?
That did, yes. You mentioned a little while ago the 5, 4, 3, 2, 1. Which year of the 10 years did you do your refi?
So I still have the loan. I actually did not refinance yet. I'm still stabilizing my 26 unit. I think I have about 7 more that need to be rented out. 2 need to be renovated. 5 are rent ready right now. So I literally just got off the call with my property manager and just said, hey, like, what can we do to rent these 5 units out immediately? And she just said, well, we can do Section 8. They've been calling me every day. So I just said, I'm open to it. If you guys want to do it, it's extra work. It's guaranteed income, but you have to do inspections and more paperwork. But if you're willing to do that, you're guaranteed money on the first of every month, right? And then there's a need for that. So I left it up to the property manager, like I'm for it, but it's up to you at the end of the day as you're managing my asset. So, if we can rent that out, I just can renovate my last 2 units. At that point, I'm 100% occupied. And then honestly, I'll probably be grossing about $18K a month and my loan's only $2K, right? So that property is probably going to be cash flowing $8 to $10K a month, which is pharmacist salary right there once it's stabilized. So,
awesome.
So basically I'm almost there, right? I mean, it's kind of been humbling. Like I own 90 units, but I'm the definition of asset rich, cash poor. Like my net worth is very high, but my amount of cash that I have is very limited because I'm constantly pumping the cash. Any extra profit that I make through rents, I pump it back to renovate the apartment complex, right? And on top of that, I'm putting in additional money of my own to renovate these apartment complexes as well. So, I renovated 40 units over the past year for some context, right? So I'm a high level flipper already on my portfolio. So, that's why I honestly, I'll be honest, this past year, I felt like I was the poorest I ever felt. And it's just because I'm constantly putting money to renovate this apartment complex. So it's kind of funny. Like my net worth skyrocketed, but like my feeling psychology wise, I don't feel very rich. I'll be honest. Like that's why I'm looking to kind of pivot to sell my mobile home park so I can get back some of that cash and then feel like I'm, where I should be with somebody who owns, 90 units, or if it's sold around 40 or 50 units. So Yeah.
Yeah. That's one of the great things about real estate is it's a get rich slow game, and it takes a while, and you're building that equity, but you don't see much of that until, as you refi, and it takes several years to get to that stage sometimes. So
Yeah, I tell people like I am probably going to be rich during the next recession or the next bull run. Whenever that next 10-year bull run hits, whatever real estate I bought at low interest rates, that's probably going to retire me. So it's just a matter of waiting. It was kind of funny. Like I was loving inflation because it made everything go up. All my assets were going up. My stock portfolios were going up, and interest rates were low, right? So selfishly it was helping me, but um, given the higher interest rates, it definitely was a little humbling. I scaled rapidly, but a lot of people say they want to follow what I did, and I just said, you can do what I did, but honestly, it's a lot of work, it's a lot of stress, and it's a lot of risk tolerance. And like you said, you're gonna have a lot of capital, right? So I had to kind of over leverage a bit, pulling equity from my single family homes in California to basically fund my apartments and mobile home park renovations, right? So it's definitely doable, but there has to be certain risk tolerance. Like if I were to kind of go back, honestly, a year, I'd probably tell myself to not go as fast. And what's kind of crazy, I bought 80 units in 8 months, right? So I got a mobile home park, 26 unit, 20 unit in 8 months. And what's crazy, in that same 8-month span, I had a RV park under contract and a 50 unit apartment complex under contract. But those fell out of escrow due to due diligence. So I could have literally had like 150 units, just me. And I probably would have gone crazy, to be honest, if I actually closed on one of those. So kind of my message and what I've been learning recently is like, it's okay to scale slow. I mean, real estate's a long-term game, right? I'm in my 30s. So like, if I do this until I'm like 70, that's like 40 more years, right? So like, what's the rush? Like, just go slow, be methodical, make mistakes, right? Like, would you rather make a mistake when you own 20 units or 90 units, right? Like, I'd rather make it at 20. I was making mistakes at 90 units. So if I made a mistake on one unit, it affected 90 units for me. So it's a lot more pressure, right? So, it's okay to kind of scale slow, but, if you kind of tell me that you have a 15-year time window to, retire yourself from your job, I'd probably say that's doable and reasonable. But I was aiming for 5 years to retire myself, and probably not going to hit it. So, well, actually, unless I rent out like 5 units in the next month, maybe.
Steven, speaking of scale, like you've scaled pretty fast, and it's very impressive. And you mentioned that you were stretched pretty thin at moments where you were pulling equity from your single families to kind of help finance some of your renovations for your multifamilies. Could you speak about scale for a little bit? Like, are you doing this all with like self-financed money, or are you doing OPM, other people's money, kind of syndicating in a small way, or is it purely just kind of going at it all yourself?
So I'm all myself, right? So I have no partners, no OPM, just me, right? So I own 90 units while working full time, just me, right? And I'm doing 3 heavy value add deals. And why I want to say that is because if you don't think you can do it, right? Other people have, family obligations, other things going on, but I'm kind of playing on hard mode, right? A little bit compared to most people. So for me, I did it myself. And the reason for that was, for me, I would feel more apprehensive losing someone else's money versus losing my own money. I think that's just the pharmacist inside of me. Like, we're risk adverse, and very conservative. Like, I wouldn't trust me. Like, if I saw me on YouTube, I wouldn't give myself money. So for me, I kind of want to okay, imagine my 26 unit in Oklahoma City, right? I did it all by myself. I bought for $500,000, put in, let's say, 300K. I doubled the value to 1.6 million. Did a cash out refinance, got all my money back plus some. I have a property manager in place, general contractor in place. I know the rents. I know the areas are good. I know everything. How easy would it be for me to raise money if I got a 100-unit apartment complex under contract within 5 miles of my 26 unit? I don't even need to ask. People will probably throw money at me, right? So for me, I kind of want to put my money where my mouth is. A lot of syndicators, they don't know, right? They just raise money. A lot of syndicates are going to be exposed when they're doing their catch-up refinance right now, right?
Right. I think we're seeing some of that.
Yeah, we're seeing that already, right? Like people are going to get exposed, right? So for me, I personally want to put my money where my mouth is. And for me, I kind of don't want to, for me, I do real estate for freedom. And if I have to kind of, report to investors, like it's just like having a boss, right? So to me, it just doesn't make sense. I mean, right now, while I have a day job, don't get me wrong, if I'm, left my day job, I might consider syndicating. But at that point, if I left my day job, I replace my income, like your quality of life will not necessarily improve if you're making 10K a month versus 20K a month versus 30K a month, right? Like your quality of life is pretty much going to be the same. Like don't get me wrong, it's very comfortable, nothing to sneeze at, but that's how I kind of did it. So, for me, I, bought my 26 unit. I got my mobile home park seller financed, and my 20 unit was a hard money loan, and I refinanced it. But to be honest, my tax returns look really bad now because I'm doing value add real estate. When you're pumping a lot of money for renovation, and when you do the refinance, whatever you pull out, it's tax free, right? It's not like, and you can write off the fees for the refinance. Plus, you're depreciating all your renovation costs over 5 years, or if you're doing bonus accelerated depreciation, if you put in $200,000 of renovation, you can write that off, day one, right? Or year one. But because I'm not making any profit and because I'm still working in W-2, I don't have real estate professional status right now because I'm working. I'm just doing it over 5 years. So it's just like 40K a year, but it carries forward, right? So like hypothetically, let's say I got married and I'm making, let's just say $200,000. My wife is stay at home and she's managing my real estate portfolio. So she's together on tax. We are a real estate professional. I can write off $200,000 a year off of my income. So I basically pay zero in taxes. And in California, we're roughly around like a 40% tax bracket, right? Give or take. So it's about, I can't do math right now. What's 40% of 200,000? Whatever that is. That's 80,000, I think. You save that much in tax, right? So saying $80,000 in take home, that's a lot of money. That's basically another pharmacist's salary. So, that's how you do real estate, right?
Yeah, I can relate to that, Stephen. That's actually one of my existing strategies is we take advantage of reps and then we do cost segregation studies to depreciate against my income. And I do a little bit of Epic consulting on the side. So that kind of adds to the inflated income, which enables the advantage when you buy real estate. Can I take you back to something you mentioned earlier, the 10-year loan that you took out? That's probably the option that we're looking at too. What's the origination fee like?
Bank of the West, it's like 0.5%. But overall, my total closing cost was roughly 3% of the loan. So it came out to be close to 10K. Yeah.
Okay. The vendor that the broker that we're talking to right now, they don't have prepayment penalties. However, they have a 3% origination fee. But I think part of that's also a little bit of point buy down, but they said it's going to be, just 3% origination, which then you got to add title, insurance, and anything else to close.
You're probably all in for 5%, 6%.
Yeah.
What are your terms?
They said I haven't gotten it back yet. On a rough ballpark, they said around 7 to 8%. And it'd be the same 10 years, interest only, amortized over 30 years.
Wow, that's pretty. If that's really your terms, that's really good. I got 7.5, and I'm personally, liable. And it was such a pain, to be honest, to get that loan approved. So I hope they're not baiting and switching you, because a lot of lenders do that. They'll quote you a low rate to get you hooked a little bit, and then when they show it to you, it's gonna be there's my DSCR loans that I was getting quoted. But you mentioned the point buy down too, but the ones I was getting, it was 11% plus.
Okay.
Non-recourse.
I've seen some of those already too. Yeah.
Yeah.
How long did it take you to close for the 10-year loan?
What was it?
How long did it take you to close on that 10-year loan?
Well, most loans will take me 45 days. for everything. It's just the cash out refinance took me double that, 90 days. But if you want another DSCR lender, I have a really good one that I'd be happy to connect you with him. He has a non-recourse option, so you're not personally liable for it. So yeah, they've been pretty great, but they're pretty strict. Like they want a good market, but I know the market that you mentioned is pretty good. And if you want, just send me a message. I'm happy to connect you with this lender, this DSCR lender that I've worked with quite a bit and referred quite a bit of people to.
All right, sounds good. Yeah, I'll definitely reach out afterwards. Thanks. That hit about all the questions that I had. Appreciate it, Stephen.
Cool. Anyone else have questions? So I don't remember the order that people came in. Yeah, Michelle, what's going on?
Hey guys, my name is Michelle. I'm currently in Washington State market also. I'm a nurse too, so hi to other medical professional out there. Anyway, so Stephen, question: what are your thoughts between investing in apartment versus mobile home park or RV park? What would be the downside of each of them?
Yeah, that's a popular question lately for me. So I have I have about 10 YouTube videos on my channel talking about mobile home parks to give you more detail. But so I kind of summarize like this: mobile home park. A lot of people like talking about it. If you listen to a lot of podcasts like Bigger Pockets, Brandon Turner, he's a big advocate for mobile home parks. What the people say about it is it's recession resistant, affordable housing, cash flow, right? And I think that's definitely the case if you do tenant-owned homes, right? So there's two models. One model is a tenant owns the home and they pay you lot rent, right? The other model is you own the home as a landlord and they pay you rent, which includes the lot rent. So it's double, right? But when the tenant owns the home, if there's any maintenance issues, they have to take care of it because they own the home, right? So if the toilet breaks down, the water heater breaks down, they replace it. If you own the home, then you replace it, right, as a landlord. So depending which market you're in, so my market's Alabama. That market, the tenants do not own their homes. It's a renter market. And for me, just from my experience, for context, I own a 90-unit portfolio, right? I spend 80% of my time on my mobile home park, which is 40 units. And I spend 20% of my time on my 2 apartment complexes and my 5-6 single family homes, right? And I spend the most amount of my money on the mobile home park. So the amount of money I invested in my 2 apartments is, I think, 70% of how much I spent on my mobile home park, just one, right? So if you have a lot of capital and you're willing to put in the work, and you need a team, right? So, okay, let me give you a scenario. I have a property manager for my mobile home park. He's not that great. I give him a C. If he was my apartment complex property manager, I would have fired him and replaced them with 3 other property managers. But because mobile home park, you can't just fire a property manager and find a replacement the next day. You have to usually train somebody that's a resident, train them on all the systems, all the processes, and typically they have to be handy as well, right? So you can't just fire somebody and then get a replacement immediately, like apartments. So that's a challenge. In terms of renovating these mobile homes, I have multiple general contractors for my apartments. Easy. I can get 3 quotes for every unit I'm renovating fast. Well, for renovating mobile home parks, it's different, right? There's different size material. It requires a different type of contractor. Typically, the type of contractor it attracts is ones you pay on an hourly basis. What's the problem with paying someone on an hourly basis, right? Regardless if you work 1 hour or 8 hours, you're paid 8 hours a day, right? If I'm paying you $10 an hour, and whether you just sit in your butt all day and do nothing, you're getting paid $80. There's no motivation to go fast, right? When you get bids for renovations, I pay you $5,000 to renovate this 1 unit. Whether it takes you 3 months or 2 days, you get paid the same. So of course they're more motivated to want to renovate faster. That's another barrier. Number 3 is the supplies are very unique. If your window gets broken, you can't just go to Home Depot and find a replacement window. You have to order it specifically somewhere. It's going to be shipped. And in 2021, when I bought mine, that's all supply chain issues. It took forever to replace a window that was just broken. It took me like, I think 6 weeks to replace a window that was broken, right? And then the next thing too is more turnover. If you pay people on an hourly basis, you're getting paid $10 an hour to renovate it. Like they can just find a job anywhere else for $10 an hour, right? So they'll just leave mid job. So in a year of me renovating my mobile home park, I literally had like at least 10. I think I had a team of 4 that I was paying. I probably churned that team 3 times in the span of 1 year. Versus my apartments, I had the same guy renovating my apartment for the past 2 years. Right? That's another challenge. Another challenge is when you want to infill the lots, right? What do you have to do? You have to buy a brand new mobile home, right? You can get that financed through 21st Mortgage. That's a popular one. They will deliver it to the lot, and then you have to hire a separate installer to go move it like 2 feet more and put it down. Reach out to the utility companies, so water, gas, electricity, to inspect it, connect the utility to turn on the power. That sounds easy. That takes like 3 to 5 months sometimes just to do that. I literally had a mobile home just sitting next to the lot for like 3 months before I can find an installer to come install it.
Wow.
And then even after you install it, you have to go through. You have to call the city, and you know how city government workers are. They take forever. There's no motivation to go fast. So like it's just like that's just one step for one home, right? And if you got to bring in like 30, 50 homes, I mean, good luck, right? That one installer that you have may quit on you, and now you're stuck, right? So, a lot of the podcasts, they talk about it in a good way because they want to raise money from you, right? Let's be honest. They just want to raise money from you, so they talk about the good. But if you own a mobile home park and you know the weeds, oh my God, it's so much work. I mean, don't get me wrong. Like you can do it, but if your goal is to just do 1 or 2, it's not even worth it. Like just do multifamily. It's so much easier. It's faster. It's easier to sell too if you want to get rid of it. Takes a lot longer to sell a mobile home park than an apartment complex. I can probably sell my 2 apartment complexes immediately, but mobile home park takes more time because it requires a lot of capital. And it requires a certain type of buyer as well, right? For me, this is just based on my experience. Like, given what I know today, I should have just dumped that money to buy another apartment complex. I should have just bought a 50-unit apartment complex in Oklahoma, where I have a team and system in place. But I had shiny object syndrome, and like I said, everyone thinks mobile parks great. I mean, it is, but if you want to be great at it, you have to be vertically integrated. So what does that mean? You need property management in-house, so you have full control over it. You need renovations in-house, so you have full control. You need installers in-house to have control. You need everything almost in-house, right? But what does that mean? That costs a lot of money. You don't want all that in-house just for one park. So to me, I tell people, if you want to buy a mobile home park, you better be committed to getting at least 10 parks, because otherwise it's not worth it to do it. You can make a lot of money from one park, but it's just too many factors out of my control. So it just is not my cup of tea. Like you said, I can close my eyes and my apartments are on autopilot, right? Versus a mobile home park, I have an on-site property manager, I have an off-site property manager, and then there's me. And despite that, I'm so heavily engaged and putting a lot of time and effort into it, right? So to me, don't get me wrong, like I bought my mobile home park for like $1 million. It's a 200 lot. It started off with like 20 lots. I probably added about another 20, so it's around 40. But I still have 160 lots, vacant. If I filled up all 200 lots, it'd be worth 10 million, and I bought it for $1 million. But it's going to take a lot of blood, sweat, and tears to fill that park up, and probably take you about at least 5 to 7 years, assuming you're full time with a team, right? Like it's just me. So obviously, like it requires a bit more work for that. So that's park owned home. So for me, if I were to do it again, I would invest with a syndicator that's vertically integrated and make sure that's tenant owned homes, right? So I think they kind of upsell a little bit. And another thing too is mobile home parks. I own 55 acres of land. You know how much grass that is? 55 acres of land. Literally, my lawnmower guy, it takes him a week to mow 55 acres of grass. By the time he's done, he has to start over because the grass grows so tall, right? And then another thing people will tell you is trees. I have 100-foot trees in my park. You know how much it costs to trim one of those trees down? It's $600 a tree, and the rent is $600. I literally lose 1 month of rent from one tenant to trim a tree, right? So, I mean, these are just some things that like people don't really talk about on podcasts, and it's just a lot of work, right? So, like for me, I got humbled, and that's why I just said, you know what, I'm buying hold, but this one makes sense to sell, so I can just scale and focus on multifamily, right? So, you know, to me, the safest, most conservative, if you want to get any involvement in mobile home park, is maybe just put a little bit, you know, $50,000-$100,000 with a syndicator and, you know, try to learn. But that's just kind of been my experience. Multifamily, like I said, it's so easy. I renovate all my apartments the same. They look exactly the same. Like LVP flooring, you know, light gray walls, repainted the cabinets or replaced it with like the shaker cabinets from Home Depot, bathtub kits. It's pretty generic. Like, you know, all in 10K per unit if you rip out everything. If it's if I keep the kitchen, it's probably around like 5K, right? Like that's how much it is. So yeah, that's just kind of been my experience with mobile home park versus apartment. Did that answer your question?
Yeah, absolutely. Thank you for that input. And I remember you mentioned that you got a burn unit inside your apartment. So when you renovate that, did you have to get like permit? And does that cost a lot to renovate that burn unit?
No, so when the whole thing burned to the ground actually. So I had to actually tear it down completely. So the problem with mobile homes is they're not as durable as like a stick-built home. So mobile homes, they don't have as much of they probably last around maybe 20 years at most. But you know, apartments, they can last forever, right? Like the structure is a lot more sturdy. So when it burned down, I put about $10,000 on each of my homes that I own for a mobile home park. So when it burned down, I just, you know, gave the fire department report to my insurance, and it gave me, I think, $3,000 to clean it up, and then $10,000 to buy a new one. So I got $13,000 from the insurance. So that's what I did. So now it's just vacant, right? Or I can put a new home there if I want to. So that's just something to definitely consider. Yeah.
Cool. Thank you, Stephen.
Yeah. So question, can you put an RV in a mobile home lot, or create storage space in the empty area? So, a lot of people, so I have like 200 lots that are actually ready to go. So that's actually a value in itself, right? So for example, I bought for $1 million, 200 lots, right? So that's 5K per lot. If you were to develop a lot from scratch, it's about 30K per lot. So that's your margin, right? I bought it for 5K, it's worth 30K if you were to do new construction. So you could put an RV on a mobile home park or mobile home lot. That's definitely a strategy that you could do. You know, usually they kind of have to approach you for that, but usually you kind of have to be in a favorable destination, right? Like near, you know, a national park, near a place where people want to be, right? But that is a possibility. In terms of storage units, I mean, I have 55 acres. I have a lot of empty land. I probably could. Probably need permits for that, but there's potential to build a storage unit. And then, you know, you can charge the tenants that are, you know, that own mobile homes there if they want to store their extra stuff there. So it's definitely a possibility that people do. But once again, it just adds more complexity and layers to it, right? Like you own both a mobile home park that has self-storage. Like to me, and this is just speaking from my experience, like just pick one thing and commit to it. Like don't have shiny object syndrome. Like, you know, I hear a bunch of people go on Bigger Pockets podcast and they're like, oh, I own like one single family home in like 10 markets and self-storage and a liquor store. I'm like, it sounds cool to say, but like in my mind, I'm like, that sounds terrible. That sounds terrible, right? Like that means you have 10 different property managers, 10 different asset classes, and you just built yourself a job that's probably worse and harder than your W-2. So, you know, it's just kind of funny hearing that piece. But definitely it is a strategy, right? Like what some people I know do is they'll buy metal storage or metal shipping containers, and you split it in half, and you use that as storage. You can buy them for like, oh geez, I think it's like $1,000 each. but I think you can get around like maybe $200 a month in rent. So you do 200 months a month in rent. It pays for the self-storage container in like 5 months, right? And then you do 200 times 12, which is 2,400 divided by the cap rate. That's how much you increase the value of your asset. So I know a lot of people who own a lot of acreage, they do that. And I was definitely thinking about doing that as well. So I know I kind of came up hard on mobile home parks. It just doesn't make sense for me when I have a W-2 job. If I was retired from my day job, I may consider doing mobile home parks again, right? But I have to reevaluate. And to me, it's just like, why do a mobile home park when I just can double down on a multifamily? It's easier. Like, like why do it? Like I done it. I did it. I scratched my itch and that's it. Right. So because of that, I don't want to do anything else. No self-storage, nothing else, just single families here and there and probably apartments in Oklahoma. Like I can become very wealthy just buying apartments in Oklahoma, as is. So that's kind of been my mindset as of late. But I did fall victim to shiny object syndrome. So that probably was my regret. I'd say over the past 2 years was buying that mobile home park and deviating from what I was the best at. Okay, great. Hey, John, thank you for so much for giving that input. Hope you can talk next time. Anyone else have any questions? Don't be shy. It's a safe space.
Hey, Stephen. Thought of another question. So for the commercial loans, the 10-year that you did, how intense are those appraisals and how much do they usually go for? Do they take a long time? I know you said it fell short. It can fall short sometimes and be inaccurate, but what other challenges kind of do you think I'd like to see?
So usually when you're under contract, your lender will recommend a bunch of appraisers that they're contracted with, and then they'll give you the time window. So I've seen usually the average is around 3 to 4 weeks to go view the property, inspect some units, and then they have to do the report, right? Now, once you get that report back, that's when underwriting might be changed, right? If the appraisal came back too low, or maybe they think, hey, the life of this property is only 20 years, so they're going to lower your amortization from 30 years to 20 years. So I would say at least 4 weeks, unless you can get that appraisal report back fast. You have to pay usually a little more. So I paid around $3,000. So, if the appraisal comes back low, if you want to contest it and get an appraisal, it's another $3,000 in another 4 weeks. So for me, I didn't want to pick that battle. I just wanted to close the loan to get it over with. So I tried to contest the appraisal report, but they didn't let me talk to the appraiser directly. And then I didn't want to spend another $3,000 to get to reappraise it. And I knew that in, 2-3 years, I was going to refinance it anyways. So, I just said, I'll just take the hit. I'm probably grossing around $9,000 on my 20 unit right now. And my loan is around $3,500. So, a little bit higher than I would like. But what's kind of killing me in Oklahoma and in Texas, it's going to kill you too, I'll be honest, is the insurance. The insurance went up big time in 1 year. My 26 unit insurance went up by $5,000. My 20 unit went up by $4,000 with worse returns, right? So, things are just getting more expensive on that end, unfortunately. So expect your insurance quote to, be high. Like I said, happy to share some. Like I'm just renewing my insurance right now. Happy to share contacts as well if you reach out to me. But
in terms of the appraisal, if I were to get it done, because it takes that long, 3 to 4 weeks, could I theoretically get the appraisal done with one loan company and then use that towards a different one?
Yeah.
Or you could, right? Okay.
It has to be within a year. So if I didn't go with that lender, I can show them that appraisal report and they would take it. And I actually had an appraisal report from about a little over a year ago, but they wouldn't take it because it was too old, right? So they want something recent. And what they threw a curveball at me, something called a land survey. I had to learn about this the hard way. So a land survey is they didn't want to know what the boundary is of your property in case there's any disputes about, hey, your fence is on my side of the line. So they at the last minute threw at me, hey, we want you to do a land survey. And I talked to my hard money lender. I'm like, did we ever do a land survey? They're like, no, we didn't require it. And a land survey literally costs $3,000. It takes another month to do it. So if they throw a curveball at you at the last second with that, it's another 2 weeks, another 4 weeks, right? So, and like if you think about it, interest rates are so dynamic. So in 90 days, my interest rate was changing like crazy. So I bought a rate cap lock. So I locked in my 7% rate. If I didn't do that, my interest rate probably would have been like 8 to 9. So that's why I kind of suspect, like, when they quote you 7 to 8, I don't believe that, to be honest, unless you're buying it down, which might be the case. But if it's the lender that I did, you're looking at 8 to 9. I don't think 7 to 8 is realistic, to be honest.
Yeah, I think there's a bit of buy down with that.
Yeah. So because of your buy down, you may have that, right?
State perk, it definitely seems a little too good to be true at the moment, but we'll see.
Yeah, and a lot of these people, they do bait and switch at the end. Like, oh yeah, this is what we quoted you, but these underwriting changed and you're getting more conservative, and they give you any excuse under the moon. And then so engage multiple lenders. I actively engaged like at least 20 lenders. It was tiring, but
Sure.
I got very good at my pitch.
I'm kind of doing that process right now, and it's certainly tiring. Now, what I usually invest in is these duplexes, triplexes. That's what I hold a couple of there in Austin. It's 2 properties, 5 units, and this 10 unit is right down the street from both of these properties, so it's fairly close. However, having not done one of these larger multi-units, they do ask for like resume, and they do ask for like documentation to show that you've done this before. I assembled a slide deck that I use, and it seems to fit the bill for now. Is there any like suggestions that you might give me for that? What format do you use for yours? And then also, how difficult is it for me right now versus for you once you've done like a couple of these? Does it really matter? Because they see, the first lender told me that it's really used just to de-risk, and that it's not really used with high regards to like, because the underwriting's underwriting, right?
Yeah.
Numbers are numbers of the finance of the property. Whether you're a really good operator or not, is just to help the investors feel a little less risk for you as one.
Yeah. Like I've been asked for resumes. Obviously I just use like my pharmacy resume, to be honest. Just any like, hey, these are but for me, I own 90 units, so it kind of speaks for itself at this point. But when I first bought my first one, like I've done a full cycle BRRRR, right, on my 20 unit at this point. And then my 26 unit will be a full cycle BRRRR. If I sell my mobile home park, that's another full cycle, right? So you just have to be able to show it. I mean, for me, because I share a lot of what I do on YouTube, honestly, I just link them my YouTube channel, and then they can see like me teaching people. So it's just a way to say like, hey, because banks are investing in you because they're putting the most of the money down, right? Like you're only putting 20-25%. They're putting 75 to 80% of the deal. So they want to know that you as the operator can run a business. Right? Like a lot of these landlords that I buy from, they're terrible. Like my 20 unit, he literally had a burned down unit for the past 5 years due to a kitchen grease fire. And the lender said that it was pulling teeth and nails just to get him to replace the roof that was like end of life. Right? But for me, I'm telling him, oh, actually, I'm going to fix that burned down unit. Like I have $40,000 allocated to fix that up. And for me, I buy good insurance. So if my unit did burn down, I'd put an insurance claim, and it would probably give me enough money to replace that unit. That landlord bought such shitty insurance, cheap insurance. So that's another lesson. You have to buy replacement cost insurance. Replacement cost insurance, not actual cost. Actual cost will, if your apartment burned down, you will not get enough money to replace it. You'll have enough money to pay back the loan. That's it. That's all the bank cares about. If that thing burned to the ground, I have a loan on it for $500,000. That's all they care about is getting their $500,000. But as an operator, if my 26 unit burned down, it's going to cost me $3 million to build it up to 2023 standards, A-class standards, right? So keep that in mind, right? So that's what I mean. Like most of the landlords I bought from, like, oh yeah, insurance was like $5,000. I already know off the bat it's going to be double or triple the cost because they bought cheap insurance every time. Like I think my 26 unit, he spent $9,000 on insurance. I think mine was $20,000. for good replacement cost insurance. So that's why you have to surround yourself with, like, you know, whether you're doing like mentorships or watch YouTube videos, you gotta like know these things, right? Like buy good replacement cost insurance. And for like Oklahoma, Texas, you want to look at your wind and hail deductibles. I just learned about this recently, right? Like, okay, you have a 1%, 2%, 3%. So 3% wind deductibles, if it's worth 3 million, it's 90K deductible before insurance covers the cost. But to get a new roof, it's 30K. So it's just kind of like a lot of things need to be damaged by the wind and hail for it to be worth it. But if my wind deductible is 1%, which is 30K, I just pay for the roof. But anything beyond that, the insurance covers, right? But your premium's gonna be higher. So that's what I mean by, like, you got to be around people who are doing what you're doing and a step ahead of what you're doing. You know, that's why I'm kind of doing these sessions. You know, I was part of a mentorship, but like they never really taught this to me, right? I paid $15,000 to be part of a mentorship, and no one would really tell me this stuff, right? You know, and then I'm just telling people like, hey, this is what I learned, and I've been doing it for 5 years. I'm not even new. So like, it's just kind of like, you know, kind of what I've been going through and learning. But, you know, you just want to have a track record. But honestly, if that thing appraises for like way more than what you bought it for, they're not going to care for your track record, but they just want confidence that. So for me, I leveraged my property manager because they had 20 years of experience managing apartment complexes. So I'm not sure if you're self-managing or hiring a property manager, but if you hire a property manager, you can leverage the fact that, hey, I'm hiring this third party. They've been in the business for 20 years, and you can check out some of the other apartments that they're managing, right? So, you know, you just have to be very on top of things and treat it like a business, right? So if something breaks, you fix it, right? If insurance does an inspection and says, hey, this electrical panel is recalled, fix it, or else I'll just fix it and show proof, right? So they just want to know that you do what you say and you'll treat the property well. That's really what you get to sell to them, and you get to sell them your operational sense. That's why when you talk to the loan officer, you tell them a story, and they can tell if you're experienced, right? Like they'll know if you're experienced or not based on how you talk and communicate. You can tell the way I'm talking, right? Like, you know, I own a bunch of properties, I'm managing and operating it, versus some marketing guy who's trying to raise money who doesn't know anything else besides the slide deck that they memorized, right? So once you start talking like, oh yeah, like I'm gonna renovate for 10K per unit, my rents are gonna be about 700, and then yeah, like as long as you can kind of confidently talk about that and really know your concepts and talk the lingo, you know, that's how you build the trust and the rapport. Does that answer your question?
Gotcha. It does. Thanks, Stephen.
Yeah, and I mean, honestly, you can watch a lot of my YouTube. You can learn a lot just from that, and kind of catch on to the lingo and kind of how I approach things. But it's just telling a story. That's probably my superpower, is I can just paint a picture and tell a story, and then it really builds confidence in me as an operator, right? But for me, I have a lot of battle scars, so it's easy now, right? Like, I think moving forward, nothing will be harder than what I just did the past 2 years, doing 90 units of renovations, right? Over like buying 90 units in 8 months and renovating them over the past year. Like nothing will be harder than this while working full time as a pharmacy director, right? So I know a lot of people ask me if I'm full time, and as a real estate, I'm like, nah, I'm a full time pharmacist. Then I do my real estate on the side, which is like 2 full-time jobs in itself. So I see here, Cindy, you have a question. So you're based out of Torrance, LA, buying your first rental property, thinking San Diego, pros and cons of buying one expensive long-term rental in San Diego versus multifamily. You can do out-of-state multifamily, but it's just, okay, got it. So for me, I started off house hacking in the Bay Area, California, right? So I was buying single family homes for about $1 million at the time, and I was putting 20% down, which is 100, 200K down, right? So I would live in the master bedroom and I would rent out the other rooms to cover the mortgage and cover my living expense, right? That's what I was doing when I was in my 20s, right? But now that I'm in my 30s, I have a girlfriend, I want more privacy. So house hacking is not as viable of an option for me right now. And I've worked hard, right? Like, I don't own 90 units in house hack. Nothing wrong with it. I mean, it helped me get started, to be honest. If you're willing to do it, it's a great way to build your financial foundation. But for me, I did make the pivot where, because, you know, believe it or not, I'm based out of LA as well right now, and I'm renting. Like, I'm renting an apartment right now. You know, I'm paying $2,000 a month for my apartment. But if I were to own a home that's $1 million in California, my monthly mortgage is all in, property tax, insurance, utilities, probably like close to 6K. Right? So right now, it just makes sense for me to pay rent as I buy real estate, small apartment complexes out of state. Right? Like, I got my, you know, San Diego, I know it's like one of the highest rental markets. I just saw an article recently saying that San Diego surpassed San Francisco because San Francisco went down and San Diego, you know, has nice weather and all that. But if you buy single family homes in California, you're banking on appreciation, right? My first single family home I bought in 2017, I bought for $800,000. It's now worth $1.3 million in 5 years. So I made $500,000 equity in 5 years, 100K per year on average, right? So if I sell that, I can 1031 exchange that to apartment complex. So I call them a little piggy bank. But for context, in San Diego, I know that townhome is probably going to be 600, 700,000, probably, right? Depending on the market. If it's La Jolla, probably closer to 800. Downside of townhouses, they don't appreciate as well compared to single family home. That's a downside, right? If you buy a condo, townhouse, it's not going to appreciate the same as a single family home. So for me, if you want, and you know, if you buy single family homes in California, let's say you buy $800,000 townhouse, you're putting 25K down, which is 200K down, your loan is 600,000 at, you know, 5% interest. Your probably all-in cost is going to be like, I even know, $5,000. I don't think you can rent out that townhouse for $5,000, right? So you're going to be negative cash flow on that townhome. I mean, if you can take the hit and just bank on appreciation, by all means, it's an option. But if it was me, you know, I'm biased, obviously, because I went out of state. I would rather get an apartment complex out of state that's somewhere more affordable. I chose Oklahoma because I got my 26 unit for $500,000. If you're in California, good luck. You can't even buy a condo for $500,000. Right? San Francisco, you're buying a little shed under the bridge for $500,000 next to some homeless guy. So for me, I chose to buy multifamily because I can buy it for $500,000, but increase the value to 1.5 million, which is 3x. Do a cash out refinance, pull my money out, right? So for me, I would lean towards multifamily, but like I said, you have to commit to learning and you have to commit to doing it. You're going to make a lot of mistakes. That's going to cost you money. You know, I've probably made at least $60,000 worth of mistakes over the past year, for context, right? And I share them openly. I don't want you guys to make my mistakes, right? I made at least $60,000 of mistakes over the past year. That's nothing to sneeze at, right? It's a lot of money. So, you know, if you're willing to do that and you're willing to relinquish control, I think it's a great option. But what I've been kind of telling people recently is just scale around your unfair advantage. If you have an unfair advantage in San Diego, scale in San Diego. If you have an unfair advantage in Oklahoma like me, I'm going to scale in Oklahoma, right? So just pick your unfair advantage. Don't question it. Pick it and scale it and do it for a long time. You'll become wealthy, right? You can literally buy rental townhouses in San Diego for the rest of your life. You'll be wealthy. You can buy apartment complexes in Arkansas, Little Rock, Arkansas that you choose. You can become wealthy. The key is committing to it for a long period of time and letting compound work in your favor. If you can do that, you can become wealthy, right? In anything you do, doesn't matter what. The key is picking one thing and committing to it for a long time, right? So that's kind of been my strategy there. So hopefully that answers the question, Cindy. And I have a YouTube video talking about the difference between pros and cons of single family versus multifamily, right? So check out that video for more details. Let's see. So I see a question from Sean. Oh, yeah, your daughter just got a free MBA in real estate. You're welcome. Sean, so direct mail marketing, I sent over 3K letters. It's very tough out there. Owners want, yes. To sell and a comfortable good equity, low interest rates. Hard to find someone that's under market. I live in the Bay Area. Cool. Yeah. So for me, I haven't done direct mail most recently, but I've heard the same where people want that 2021 pricing, but at 2023 interest rates, right? So what's the solution to that? It's seller financing. Your price, my terms, right? Same mentor, that's what they taught us. Your price, my terms. I will give you your price, but give me terms and you get to seller finance it. That's the only way. If they're not motivated, then they're not motivated. Move on, right? I know in the Midwest, if you send out 300 letters a month, it's about a 1 to 3% response rate. So it's about, you send out 300 letters, you get about 9-10 responses. If you're in a hot market like Florida, Texas, 1% response rate. So 3 to 4 responses a month. So the key is you got to just keep on going. And, when you send letters, you're buying situations. You're not buying real estate. When you first sent the letter a year ago, they're not motivated. A year later, maybe there's the death in the family. Maybe the owner died. The kids don't want to manage it. Maybe there's a divorce and they want to rapid sell, whatever they own. Maybe there's disagreement. The partnership needs to dissolve, right? Maybe there's disability and the owner will self-manage it and can't manage it anymore, right? So, if you have a motivated seller and a motivated buyer, that's how you make deals happen, right? So, it just requires consistency and grit and just keep on going, right? Like, I was fortunate. I probably got my first deal within 6 months of joining the program. But as I mentioned, for the first deal, if you do it, you're gonna have to give up some equity because the mentor requires you to give up at least half the equity on your first deal. That's what I gave up. But to me, it's a small price to pay to learn how to do it, right? But to be honest, at this point, I don't really. I'm kind of self-sufficient at this point, so that's how I was able to scale rapidly on my own. So I just would say keep on going. Maybe expand to other markets as well. I mean, the Midwest is pretty large, and you just have to be consistent and keep on doing it. And just know that once you get that first deal, it pays for all your marketing. And the hard part is people aren't willing to do it for a year. And kind of Sean, probably my inkling is like it's how you talk to the owners as well when they call you, right? You have to. I would recommend you record yourself when you talk to them, and then send me the file, and I'd be happy to analyze it with you, right? Like just record yourself talking to these owners, and let's listen to it. I'll share it on one of my sessions, and let's debrief on how we can improve on that. So to give value to everybody as well as whoever watches on YouTube. So I would love to do that, right? As I said, I love to teach naturally. It's organic in me. I did pharmacy school, which is layered learning, right? When you're a first year, you learn from second year you learn from third year you learn from a fourth year you learn from a resident. So I've been through that my whole life, right? So just giving back to people who are one step below me, and everyone here is one step below me, essentially, right? Like I'm literally one apartment away. The difference between me and you is one apartment complex. That's the difference, right? So it's definitely doable there. So hopefully that answers the question. And when you send the letters, you have to slightly tweak it too. So what I kind of teach a little bit different from that mentorship is you got to kind of slightly modify your letter based on your response. It's more of an art than a science. But it's just being consistent with it. And like I said, I had a bunch of sellers who weren't motivated. And I just said, you know what, I'm gonna make you an offer that makes sense for me. Take it or leave it. If they don't want it, fine, move on. Right. So that's what I do all the time. Like, that's why I was so amazed. Like I always made offers. Like when I was looking for deals, I was making like 4 or 5 offers a week, at least. And I would just make offers that make sense for me. And if they didn't like it, whatever. I did the best that made sense for me. And it shows that I'm serious. Like, here's an offer next day. And when I'm trying to sell mine, most people are not that action oriented. They just sit there on the sideline. I'll think about it. I'm like, dude, just make an offer that makes sense for you. And I tell people, make an offer on my mobile home park that makes sense to you. And a lot of them are just like, oh, I don't know. So yeah, Josh, I actually write my own offers. I have a template I use for LOIs, letter of intents. And if you need a purchase and sale agreement, you can usually Google it. Like you just can Google, each state has their own purchase and sale agreement. It's pretty self-explanatory to fill out. Or you can ask title to say, hey, can you give me the most the purchase sale agreement for the state, and they're usually happy to give it to you because they want your business, right? So I've written purchase sale agreements at least 3 times already on my 3 deals that I've done. So I didn't have a broker involved. So it's not that hard, to be honest. Like, you know, if you can finish pharmacy school, I assume you can write a contract. As a pharmacy director, I feel like I'm a lawyer anyways, you know, reading the pharmacy law. So to me, it's very natural for me to do it. And once you do it once or twice, it's not that bad. Like, I'm not sure if I released the video yet, but I have a video where I'm like walking through how to write a purchase and sale agreement contract, right? And how to do that, and helping teach people, you know, how to do that as well. So I usually write my own offers. It's pretty simple. You just like, what's the purchase price? What's the down payment? What's the earnest money deposit? What's the time window for due diligence? What's the time window for closing? Usually 60 days. And then which escrow company do you want to use? And that's it. It's pretty simple. They agree to it, then you do a purchase sale agreement. Pretty simple. Hopefully that answers your question, Josh. So I know I ran a bit late. Any last minute questions? Last call for questions. Yeah, great question, Josh. So I had 2 deals that I had under contract. So I had a mobile home park in Oklahoma. It was a half mobile home. I think it was like 50 spaces for RV, 50 spaces for a mobile home. Oklahoma was a park-owned home model, so the landlord has to own it, and they're just renters. And it was a nice deal. It was a lagoon. So lagoon is a private utility, and they had a well, which is also a private utility. So a lot of big syndicators, they don't like private utilities, right? They want city water, city sewer, simple, right? So, you know, the numbers were great. Like, I was getting financing, I think at the time, 25%, 35% down. They allowed seller carry second 10%, 5% interest only for 2 years, amortized over 30 years, I believe. That's really great terms, right? And the cash flow was good. But what happened was, during due diligence, I was doing due diligence on the lagoon, and I found out that, number 1, it wasn't permitted. And number 2, it was too small for the size of the park. That's why it was not permitted. So what does that mean? That means I have to bring it up to code and get it permitted. How much does that cost? That's $150,000, right? The well was an agricultural well, not safe for human consumption. And guess what? They were using it for human consumption. So if you have E. coli in the well or poison, and someone drinks it and they all got sick, they can come back and sue you, right? So I needed to install wells that were for human consumption and needs permits. How much does that cost? $150,000, right? So what did I do? I just said, well, I offered you what, I think it was 2.3 million or something like that. I said, I want $300,000 to sell repair credit so that I can get the lagoon and the well permitted to meet code, right? And he said no, so I backed out, right? That was my first one. My second one was a 50-unit apartment complex in, it's between Oklahoma City and Tulsa. It was probably about 30 miles away from my 26 unit. It looked great on paper. It was an elderly woman. Oh my gosh, she had everything written on paper. Like, she literally had a composition notebook, and she would write down the rents every month, right? And what happened was, the property manager was stealing from her. So they were stealing like at least $10K a month from her, right? So she wanted to sell it. And I remember literally calling her and being like, okay, you number 1, when did the lease start? How much is their rent? What's the security deposit? I would go by one and like write it down, because like her paperwork was a mess. So I was doing due diligence, and I think it fell out when I did it. I think I sent my property manager there. He took a look at the area. It was a little bit rougher than I would like it to be. And it was a smaller tertiary market or secondary market. So we just thought that, I think in that market, it was only 2 apartment complexes. There was the one that I had under contract, and another one. So it just kind of, I think the occupancy was a little bit inflated than what she was showing, like almost 100% occupied, but I didn't quite believe that given that market. It's a little smaller. So I think it was just those type of concerns led me to not pull the trigger. So I'm glad I did it. I think I was trying to wholesale it at one point to get a quick buck, but couldn't do it. So I just walked away. But yeah, if I got that, I would have 140 units. Right. And maybe bankrupt, who knows? But yeah, on that deal, actually, I was actually looking to raise money with people because I used up all my own capital at that point. But I had a feeling with my 90 units that like I was kind of maxed out. So like I have a high stress tolerance and I'm very efficient in what I do. But I finally hit like a point where I'm like, I started to forget things. And that's at the point when you hit your max capacity. So I knew at that point I could not do any more real estate and do it well. Like, I was making so many dumb mistakes, like rookie mistakes, just because I was so like overwhelmed and stressed and burnt out. So this past year, I've literally slowed down and try to set up my systems and processes in place so I don't mess up, right? So that's the danger of scaling too fast. So I'm definitely learning, and that's why I'm starting to sell. So that's why I fell out due diligence. So, don't feel bad. Like, I got my earnest money deposit refunded, but sometimes you might pay for inspections and whatnot. It may cost you, $2,000-$3,000 to inspect it. And if you walk away from the property, it's okay, right? That's just the cost of doing business. If you cannot afford to take $2,000-$3,000 loss, then you have no business doing multifamily or commercial real estate, to be honest, right? Like that's what I tell people. Like, if you're not willing to like invest in education, invest in, whatever that is, courses, mentorships, attending free masterminds like mine and putting in that work, like you have no business doing commercial real estate, right? Like it's definitely a different mindset, a different game, and a different mentality compared to single family homes. So, this is kind of why I offer these free sessions where, I've been part of a mentorship, and people who are mentorship are attending my calls, right, to learn. So it says a lot, right? It says a lot that I'm literally that I'm paid for mentorship, and people who pay for mentorship are learning from me. And I'm pretty transparent with what I've listened to a lot of podcasts where they're trying to sell you their mentorship, and they withhold information. Like, if you ask me, I'll just tell you. I don't care, right? I want people to learn and want to get the information out there and want to give value to people, because I know it'll pay dividends to me one day if I give value to people and teach people. I don't know when it will pay dividends, but it may one day, right? So that's why I fell out of due diligence. So don't feel bad. I mean, that's part of the process. But for me, when I usually have a deal under contract, my mentality is, how can I make this work? Right. But if it doesn't work, like I said, if that guy said, hey, Steve, I'll give you $200K or $300K to sell repair credit, I still might have done the deal and try to raise money. Right. Because I would have reduced my down payment significantly. And I'd have the money to fix the lagoon and the well and bring it up to code. And I would explain to them, hey, like, this is not up to code. You can get code enforcements, which can shut down your whole park. That's risky, right? Imagine you bought it. And then the lender, they ask me for permits. And if they don't see permits, they're going to be like, well, what's your plan of action? Once you take over that park, you better get it permitted. Right. So like the onus is on me. So like, to me, I'm like, I'm only willing to take the risk if I get compensated for that risk. Right. So if I did get $300K back, then it would become, okay, how do I bring it up to code? Right. And do the right thing. So that's kind of it. But yeah, it was a nice park, man. Like, I could have doubled the number of mobile home pads as well. It had double land that was unused. It was near a national park as well. So I thought it was a home run, but it fell out. And yeah, maybe I wish I did a mobile home park in Oklahoma versus go to a different state in Alabama, which is where I did mine. So yeah. Any other questions? I'm loving the engagement. Loving the engagement today. No, any last call for questions? Oh yeah. So contingencies. So I have a video, I think, talking about it as well. But for me, the key is due diligence. period. And I specifically will say you have to provide me documents within a time. Like, so I usually do 30-day due diligence, 30-day, 60-day close. That's the typical term that I do. But within that 30-day due diligence, I do a caveat of saying you must provide me with the requested documents within 5 business days. If you don't do that, then the due diligence period gets extended an additional number of days. So that's how you protect yourself, right? So that's a hack that I've done for that. And another thing I think I do is, I think for the due diligence, I try to do that. I think that's my main one, just to give me a backup. And obviously, the earnest money deposit is or refundable back if I cancel on it. And typically, if I ask for extensions, you want to be proactive about it, right? Like, you don't wait to the last day. You want to ask at least 7 days before your periods, and be reasonable. Like, hey, like, I ordered an inspection. They're running a bit behind. It's scheduled for this day. You know, we try to schedule your property manager. You know, they weren't available to this day. Like, can I have more time? As long as you're reasonable about it and ask ahead of time, usually they accommodate it. They may ask you for a little bit more money for earnest money deposit, but sometimes you can kind of get away with it if you don't. So that's what I mean. Like, I never thought just being transparent and communicative and open gets you so much in life. Like, honestly, like, just me doing that helped me so much in life, right? Like, this is not just real estate. This is anything. Just being open, transparent, communicative, and responsive gets you so far in life. Like, I built my whole pharmacy career and real estate career on that basis, right? So that's for me to do. And another one is a financing contingency. Obviously, that's pretty standard. You know, obviously, if it doesn't appraise or you need more time or something like that, then, you know, you can back out that way as well. Yeah. So Michelle, I'm gonna pull up my calculator for this. So, how did the cap rate affect my refinance value, right? So my net operating income on my 20-unit apartment was $50,000 a year, right? So $50,000 divided by a 10 cap, which is 0.01, that's going to be a valuation of $500,000, right? You take that same 50K NOI and you divide it by 0.085, 8.5 cap, it's now worth $590K. That's a $90K difference in the valuation, right? Just by the cap rate going from 8.5 to 10%. That's huge, right? If I'm doing a cash out refinance, I'm getting 75% loan to value. So 590 times 0.75%, your loan is 440K, right? Versus if you're at 500, 75% loan to value, your loan is 375K, right? So that's a difference of you pulling out about 65K, which can be significant, right? If you're trying to pull all your money. So, you know, for me, like I said, it sucks, but honestly, when I cash out refinance this again in 3 years, whatever, right? I think I put 200K into the deal between renovation and down payment, and I left about 120K in the deal, which isn't that much in the grand scheme of things. And I'm probably going to pull it out once I do my cash out refinance again in like 2-3 years. So, you know, it's pretty basic math.
So that's how you calculate the valuation. You use your net operating income and divide by the cap rate.
Yep.
Okay.
That's it. That's all they look at. It's just, so if you want to cheat the system before you do your cash out refinance, lower your expenses significantly. Just don't defer paying for things. That's kind of a hack, but you have to do it for like 3 months. You know. So, but because I was under the gun with my hard money lender, I just, you know, whatever. I took the low appraisal and just moved on to my life, right? You know, I thought the deal was going to be a home run, but it became a base hit. But I still got a base hit, right? So I basically own a 20-unit apartment complex, grossing $9K a month. That's fully renovated. I can't complain, right? Yeah. Any other questions, Michelle? Did that make sense?
Yeah. Thank you so much.
Cool. Well, if no other questions, yeah, I do these sessions every Tuesday at 7 p.m. It was nice to see a lot of people. It's been a while. It's been one-on-one for a while for me, which is great for the other person. You get one-on-one free coaching. But yeah, feel free to invite anyone that you know that would be interested in learning. Check out my YouTube channel. I probably have like 250 videos at this point, talking about many different topics in my experience. And constantly, I think I release about 2 videos a week on top of these sessions. So yeah, hopefully you guys hop on and invite whoever, and hope to see you guys next time. Thank you so much. It's the same link every time. Yeah, it's the same link.
Awesome. Thank you. Have a great night.
All right. Thank you so much.